Tokyo's office rents are rising now, by as much as 15%. Vacancy rates are falling fast, down to just 4%. And global money is pouring into Japan right now. Yet despite this surge in demand, Japan's real estate stocks remain deeply undervalued, still trading below book value. Today we reveal three giants that dominate Japan's property market: Mitsubishi Estate, Mitsui Fudosan, and Sumitomo Realty. Together they shape the future of Tokyo's skyline, and investors worldwide need to pay attention now. In March 2025, the Bank of Japan finally ended its negative interest rate policy, a historic shift after nearly a decade of ultra-loose monetary policy. Rates are moving up, and while they remain low compared to the US or Europe, for Japan, this is a sea change. At the same time, the yen has weakened to more than 160 to the dollar, its lowest level in over 30 years. For global investors, this means Japanese assets suddenly look like bargains. And they are buying aggressively now. Blackstone has purchased hotels in Tokyo and Osaka. Middle Eastern sovereign wealth funds are eyeing logistics facilities near Narita Airport. Singapore-based REITs are adding Tokyo office towers to their portfolios. Inbound tourism is also back with force. More than 30 million visitors came to Japan last year. That's driving demand for hotels, shopping centers, and even serviced apartments. Meanwhile, Tokyo's office market is recovering. Vacancy rates in the 5 central wards, Chiyoda, Chuo, Minato, Shinjuku, and Shibuya, are down to 3.84%, below the natural vacancy rate of 5%. Prime office rents in Marunouchi and Nihonbashi have jumped 10–15% on renewal. Some tenants are paying even higher just to secure premium space. Yes, higher interest costs are a risk. But Tokyo's demand fundamentals remain strong, and that's why foreign capital is flowing in now. Let's begin with Mitsubishi Estate, the company that literally owns Marunouchi, Tokyo's Wall Street. In April–June 2025, revenue rose 8.7% to 356.9 billion yen. Operating profit climbed 20% to 62.4 billion. Net profit surged 23% to 32 billion. Growth is being driven by residential sales and rent revisions in Marunouchi and Otemachi, where tenants are paying 5–20% more. Mitsubishi's flagship project is the Torch Tower, a 390-meter skyscraper set to open in 2028 as Japan's tallest building. It will include offices, retail, hotels, and cultural facilities, anchoring Tokyo's next-generation business hub. But that's not all. Mitsubishi operates parkhouse luxury condos, shopping malls across Japan, and logistics facilities for e-commerce growth. Internationally, it owns offices in London and residential projects in the US. On valuation, Mitsubishi's PBR sits around 0.8, meaning the market still prices it below its asset value. That's rare for a company with such dominance in prime real estate. The risk? Short-term borrowing has increased, making Mitsubishi more vulnerable to rate hikes. And management has issued cautious guidance. Full-year profit forecast of 270 billion yen, slightly below analyst expectations. Still, with unmatched control of central Tokyo and iconic projects underway now, Mitsubishi Estate remains the cornerstone of Japanese real estate. Next is Mitsui Fudosan, Japan's most diversified property developer. In April–June 2025, revenue surged 27% to 802.3 billion yen. Operating profit jumped 58% to 160 billion. Net profit nearly doubled, up more than 90%. Residential sales were a key driver, with segment profits skyrocketing over 150%. But Mitsui is more than housing. It's redeveloping Nihonbashi and Yaesu with massive mixed-use projects, including Tokyo Midtown Yaesu, opened in 2023, which features offices, retail, hotels, and even a bus terminal linking the entire Kanto region. These redevelopments have lifted district-wide rents by 10–15%. Mitsui also operates Lalaport malls, luxury condos, logistics parks, and hotels. Globally, it has projects in New York, London, Shanghai, and Singapore. Financially, Mitsui recycles capital efficiently. It sells mature assets, reinvests in growth, and rewards investors with share buybacks and rising dividends. Valuation? Its PBR is still under 1.0. The market values Mitsui below its net assets despite strong earnings growth now. This combination of diversification, global reach, and investor-friendly policy makes Mitsui Fudosan perhaps Japan's most complete real estate play. And finally, Sumitomo Realty, the leanest of the three, but among the most profitable. In fiscal 2025, revenue topped 1.01 trillion yen. Operating profit hit a record 271.5 billion, up 6.6%. Sumitomo specializes in offices and condos. Condo sales remain strong now, supported by high demand and limited supply in central Tokyo. Brokerage and management income are also rising. What makes Sumitomo unique is efficiency. It consistently posts the highest margins in the sector, with ROE above 10% versus peers averaging 7-8%. The company has stepped into overseas markets too, launching its first U.S. rental project near Washington, D.C., a small but important step toward diversification. Risks: rising construction costs, higher mortgage rates, and potential cooling of condo demand. But Sumitomo's discipline, steady profits, and strong balance sheet make it a favorite for investors seeking stability. Now let's compare the three. Mitsubishi Estate dominates Marunouchi with mega projects like Torch Tower. Its strength is scale and landmark control, but higher debt and reliance on central Tokyo bring risks. Mitsui Fudosan is the most diversified, spanning offices, malls, logistics, hotels, condos, and global assets. It offers growth, flexibility, and stronger shareholder returns. Sumitomo Realty is lean and efficient, focused on condos and offices with sector-leading margins. It lacks Mitsui's diversification but delivers consistency. Key metrics tell the story. Revenue growth, Mitsubishi plus 8.7%, Mitsui plus 27%, Sumitomo plus 5%. Operating profit growth, Mitsubishi plus 20%. Mitsui plus 58%, Sumitomo plus 7%. RO, Mitsubishi tilde 8%, Mitsui tilde 9%, Sumitomo tilde 11%. Dividends, Mitsui leads with consistent increases. Mitsubishi is stable but conservative, Sumitomo pays less, prioritizing reinvestment. And valuation? All three trade below book value, a rare discount in global real estate now. Looking at 5-year stock performance, Mitsui has outperformed, Mitsubishi has been steady, and Sumitomo lags slightly but compensates with efficiency. Each stock tells a different story: growth, diversification, or stability. But no sector is without risks. Interest rates are rising. A 1% increase in borrowing costs could squeeze profits significantly. Construction and labor remain expensive, putting pressure on project margins. And in 2028 to 2029, a flood of new A-grade office supply will come online. If demand slows, vacancy could rise again. Another risk has just emerged. In September 2025, the Bank of Japan decided to begin selling its ETF and REIT holdings from early 2026. For REITs, the annual amount is small, about 50 billion yen at book value, but the signal is powerful. It marks the start of long-term policy normalization, and could put downward pressure on REITs or shift capital flows across Japan's property sector. Investors must pay attention now. On top of this, policy reforms, tax changes, zoning, ESG requirements could reshape how projects are financed and built. Yet the outlook remains compelling. Inbound tourism is rebounding strongly. Vacancy rates are falling. And mixed-use, sustainable redevelopment is attracting global ESG investors. Short-term headwinds are real, but for selective players, the long-term growth story remains intact. Mitsubishi Estate, Mitsui Fudosan, Sumitomo Realty, 3 giants, 3 strategies, 1 city transforming now. So, which would you invest in now? Mitsubishi with control of Marunouchi, Mitsui with unmatched diversification, or Sumitomo with efficiency and high margins? Comment below, and subscribe to Sakura stock for more insights into Japan's hidden market gems.